Good morning. Welcome all of you. I hope all of you are doing fine, well. So we are all in a situation which we have not experienced in our lifetime. Fear of COVID, lockdown, unemployment, uncertain about future, and many more which are haunting us. Topic of the day, effects of COVID-19 monetary policy on bank credit in India. How the world has changed from December when China officially declared about the virus in Wuhan and it spread throughout the world. One of the reasons for this spread is globalization, where the world had shrunk and now we are globalizing. Is this future going to be permanent? Hopefully not. According to the Organization for Economic Cooperation and Development, the effect on the economy's growth as shown in the graph here, it shows that pre-COVID itself, most of the Western countries were under the recession, means the growth rate was very, very low, including an Asian country like Japan. So whatever is the prediction by this OECD is that it's only by 1% there can be a fall in the production. If you see the worldwide, now worldwide it was 2.9 and now it is going to be 2.4. That is what the prediction says. But it may not be so, it may be still lesser. There are also experts saying that there may be worse than the Great Depression of 1929, where the situation will be worsened. It will be difficult for the economies to come back. So when we are coming to Indian scenario, what do we see? What are the predictions? So if you see Nomura, they have said that we are going to go for minus, and then Fitch is also predicting it is going to be 2%. So most of them have predicted that is very, very low. Even IMF says that it is 1.9 will be our growth rate. So in these situations, are we going to be in the same position or are we going to change with our policies which have been taken up both by fiscal policy and also the monetary policy which has been given by our finance minister and the governor of our RBI. So is it going to change? That's what we have to see, but to what extent we are going to improve. So if BRICS countries as it is, we know that they are in a better position than the Western countries, but still, what is the position? So now let us first understand, now coming to the topic about, we'll come back to the, but one good thing, if you have seen today's paper, we'll see that PMI, that is Purchase Manager Index of the service sector, it is improving, the index is improving. So now we'll come to the topic about the monetary policy. What role does monetary policy play in the economy and various developmental and regulatory policy measures taken by Shaktikant Das, the governor of RBI, and also his team. So what they want to do. So first let us understand what is monetary policy. So monetary policy is basically to control the macroeconomic goals of the economy. Money supply has to be controlled. So what role does it play, this money supply? To begin with, I want to go back to the history or evolution of economic transitions that have taken place. So if you go back to 1929-30, what do we see there is there was a Great Depression. So our US and also almost all European countries were facing this problem. So they had to come out of it. So what was the situation at that particular period? The situation was that they were all pure capitalist economies, non-intervention of the government. Government was not intervening. Everything was left to the market. So it is the market equilibrium, demand and supply. That is what was determining the price for a product, and the market used to get cleared. That was the philosophy that was followed, and they were the believers of that, and they went on with that. That is how the wealth of the nation will increase. That was what Adam Smith also said, that they believed in all such things. Of course, that is how perfect competition has to be there in the economy. And then government role in the economy was only to maintain law and order and administration. That's the only job. Only that, what is required for that, only that extent they were collecting the taxes, or the budget was a sound budget or a balanced budget. But what happened in this period? Somewhere the market failed, and with the failure of the market, there was a Great Depression, and this market failure, one of the reasons is the share market also is said to be, the stock market is one of the reasons why the markets failed even at that particular period. Even before that, there were such incidents, but it was not so severe as the present one. And then how to come out of it? There was a stagnation. Economies had come to stand still. So it was Lord Keynes who gave a suggestion, and then it was taken up by and then President Roosevelt, and he said, what did Keynes say? Like, when nobody is ready to invest and if the economy is not growing, why can't government take up? Why can't government invest? So government investment started, and government intervened in the economy with 3 R's, that is recovery, revival, reformation. These 3 R's they introduced, and the economy slowly picked up. And now how could they do it? Because they did not have any finance with them, they did not have any money with them. They were never having any surplus budget, nor they were following any deficit. It was a sound budget. Then how did they manage? So it is always they went for a deficit budgeting. So deficit with the deficit budgeting, so the fiscal policy, that is intervention of the government in the economy to correct the economy, to achieve the goals of the economy. What are these goals? Whether if it is a monetary policy or a fiscal policy, the goal is always growth, stability, and then further development, and removing the inequalities of the income or removing the regional inequalities. These are the goals of any economy. Basically, it is the goal. It is the growth of the economy. So to have that growth of the economy, so they adopted this fiscal policy. So they went for deficit financing, but how, deficit budget. Now this deficit budget has to be financed. How did they finance? So the Fed reserves were not there, no borrowings was possible. So how it was done? Of course, it is monetization had happened at that time. No doubt, the too much of monetization by 70s. What was the problem? End of the 60s and 70s, there was stagflation. What is stagflation? Too much of money. That is inflation accompanied with unemployment. So unemployment problem was there and inflation was also there. So how to come out of it? So then whatever, what you call as classical economist, Fisher said, the quantitative theory of money, the same was restated by Friedman. And what did he do? He said it is by controlling the money supply, you can achieve the goals of the economy. So why have gone back there? Mainly to connect with fiscal and then the monetary policy. Today, throughout the world, we are using both fiscal measures and also monetary measures. Along with that, many other more measures like commercial and other things. But more important is this fiscal monetary policy and fiscal policy. So they go hand in hand always in the present situation. So that is what has been done in our economy also after this COVID problems. So now, as I told you, what is the monetary policy? What it wants, the goals. What is this goal? First is mainly monetary policy tries to control the inflation, controls the money supply, and growth, encourages the growth, consumption. So only if you have money in the hand, you can consume, demand will increase. So that can be possible by pushing more money into the system. So this is what is a monetary policy all about. So then we'll see, how do you know that whether the money supply is more or less? Actually, according to classical this quantity theory, money supply should always be equal to the GDP of the country. It should balance. But today we know that money supply grows in an exponential manner, whereas the growth rate is always at a lower level. It is arithmetic progression. The growth of the output grows at a very slower level. So the problem arises here. Too much of money, then you have to control the money. But today's situation is not that you have to control the money. Today's situation is that you have to push the money into the system now. So now the indicators, how do you know that the problem is there? Usually the monetary base. So what is that? Currency ratio with the CRR. Then you have this high powered money. They are the base. How do you come to know? How does the RBI come to know? And then we have this, what are the interest rates being given by the banks? And then what are the banks' liabilities and assets? These are the indicators to know and calculate. And of course, RBI always gives what is the money supply in the economy in 4 different ways: M1, M2, M3, and M4. What we use is M3, money supply. So the next indicator, how we are targeting? What is targeted with the monetary policy? Usually they target the long-term interest rates, they target the what you call as bank credit, and that will affect the money supply. Bank credit, how much loans have been given, how much loans have been dispersed by the banks, how much funding is being done. This will have an influence because single bank is not creating the credit. It is the banking system as a whole which is creating the credit. So it is the banking multiplier which multiplies the money supply in the economy. So what I want to say is here, money can be multiplied. Morning 100 rupees can become 1000 rupees by evening or more than that. But it is not possible in case of production. Production takes its own time. So balancing this is the major problem of any economy. So now coming to the top, that is what we have seen. So now what RBI has done, what were the measures that they have taken? So before going to that, we see first the instruments. So what are the instruments which are there? So general or quantitative instruments they are, and selective or qualitative. So because all this are already highlighted in the present monetary policy. So if you have an insight of this, then it is easier to understand how this monetary policy or present monetary policy is having an impact on the money supply. So what is the main purpose of this monetary policy today? They want to push more money into the system. More money has come in the hands of the people. That is rather banks. And then banks are supposed to give loans to the general public so that industrialization is there, employment is there, growth is there, demand is there. So these things have to be improved. So here, what are the tools? The tools are, one is cash reserve ratio or CRR, what you call it as, then bank rate is there. Now what is CRR? Of all the total deposits of a particular one bank, they have to keep some percentage as a reserve so that the banks, whenever they are having problem, they can use this particular money. So that is why CRR is kept aside. Then bank rate. What is a bank rate? It is a rate at which they are rediscounting the bills. So this time monetary policy has not touched upon this, the new policy. Then open market operation, that is selling and buying of the government bonds and securities, which they have done. And then you have, basically they have touched more upon the repo rate and the reverse repo rate. So what is this repo rate? Why is they have changed reverse repo rate? They have changed thrice. So what is the repo rate? So the banks are getting funds from RBI. So at what rate they are getting these funds is what is called as a repo rate. Then what is a reverse repo rate? Any surplus if the banks are having, usually they are supposed to lend it. To avoid the problems arising of lending and creating a NPA, the best way is whatever surplus is there to park it with the RBI. So if you're parking your extra money with the RBI, RBI pays you a interest. So that is what is called as this particular repo rate. That has been reduced to 3.25. Thrice it has been changed. Anyway, that clearly I'll tell you with the table following later on. Then we have this quantitative. This may have impact or may not have impact on the money supply. Whether the money supply is going to increase or decrease cannot be said. Okay, but selective tools are very effective because you are targeting directly on that. So it can be credit rationing, how much should be given to the priority sector, how much should not be given, whom should be given, whom should not be given. So you can channelize the resources of the economy in a proper direction so that what is required for the economy, you can achieve it. So lending margins, what is the lending margin? What is the moral suasion? Means what is moral suasion? It's nothing but then what is the goal of the economy has to be explained those who are in this field. In the field is chairman of various banks. They should know in what direction government wants us to go. So in the same direction, they also have to speak and take the actions what is given by the our central bank. Then if they are not listening to that, they can also have a power of direct control. So these are certain what you call as tools. I'll come to that topic. Now, what objectives, as I already told you, what it wants from the monetary policy. We want growth, we want social justice, we want stability. So basically, modulate the money supply in the economy. We have to control the credit. As I told you, money supply will be increasing in an exponential manner, whereas production is always slow. So you have to match it. So that becomes the main problem of our monetary authorities. So now, what the role of the what you call as RBI has been doing it, taking what it has decided. So let us go to that particular thing. Now, there is always a lag. First of all, recognizing what is the problem. After recognition of the problem, you have to take an action. That becomes your inside lag. And once you have done it, then you release the monetary policy. But what is the reaction in the society? What is the reaction of the banking sector in the financial institution? Is an after part. How they are going to react, whether whatever government wants, will it be achieved or not, is a secondary thing. So that is what we have to see now. So now that is these are the problems. Always forecasting the effect of monetary policy. How it is going to have an impact, you cannot say. Though I am going to say the bank credit, what is happening? It is very difficult to predict what it is going to have an impact. And then how the non-banking financial institutions are going to be. Know that non-banking financial intermediaries or these corporations are already having a lot of NPAs, non-performing assets. And then underdeveloped money, and another problem in our economy is that money market is not developed. The instruments to be effective, it has to be developed. That is also a lacking in our economy. So these are some of the problems or the limitations. So now, what are the types of the monetary policy? One can be expansionary monetary policy, or it can be a contractionary monetary policy. So what we are following in this situation? We are following an expansionary monetary policy where we are pushing more money into the system by reducing our CRR, reducing repo rate, and then marginal facility, standing facility we are increasing. So many benefits have been given, and then moratorium is been given where your what you call as holidays have been given for your EMIs for 6 months, which will be equated later on. So these are the measures which the government means you are pushing more. That is, in the sense the RBI is pushing more and more money into the system. But how it is being utilized, the impact will be there, it only time will tell us. So now, usually expansionary, what is there? Interest rates will be reduced so that accessibility of loans or credit is easier. And then economy is under recession. You have to say startups have to come up, people have to take money, invest, and then growth has to be there. Employment has to increase. We have seen the unemployment problem is there, and then so many firms have shut down. That we have to revive. So what is main requirement there? Credit is required. Who can give this credit? It has to be the banks. And banks, are they coming forward? So if they have to come forward, these are the benefits which have been given to them. So that is what is called as expansionary. We have seen already during the recession, financial crisis of 2008, almost zero or no interest bailing out was done, and then no interest was there. Even now also, Western countries, the interest rate is either very negligible or zero also. So why? Because they want to encourage, because they're already in the recession. Their growth rate is very, very low, as we have seen in the table already. So now we have seen what is contraction. When do we go for contraction then? If there is inflation, too much of money supply is there, you're not able to control the inflation, then we have to see to it that all the CRR, repo rate, reverse repo rate, all the measures have to be raised so that there will liquidity crunch will be there, liquidity shortage will be there, and then demand will get reduced, and slowly the demand is falling, the prices will fall. That is how it has to be managed. So now, this present COVID period, what the government has or RBI has done. So first of all, expanding liquidity in the system, sizably to ensure that the financial markets and institutions are able to function normally in the face of COVID. So they have to function normally, and that's what I was telling. So that is why liquidity, expanding the liquidity, and then reinforcing monetary transmissions so that the bank's credit flows on easier terms. Easily they should get the credit. So that is another thing which they have to do. Then easing financial stress. What is stress is there? That has to be eased. And then improving the functioning of the markets. High, what you call as, there is a lot of fluctuations. That fluctuations have to be reduced. So now we'll see you can see in your slide that what are the measures that have been taking place. Say, for example, in the March, okay, I'll be slow. Am I going a little fast? But have you understood whatever I have told? Because it's a theoretic part, I was little at a faster pace. Anyway, so now I'll be slower. Now, now monetary policy. I have just listed down whatever the government has done in these 3 times they have announced. So on March 27th, the repo rate, earlier it was 5.15%, and now they are reduced by 75 base point. 1 is equal to 100 base points. So it has come down to 4.4. Then the reverse repo rate, it is 4.9 it was, and now it has come down to 4%. Means again, the 90 base points, it has been reduced. And then cash reserve ratio, it is 4%. It was earlier 4%. Say cash reserve ratio was 4%, and it is 100 base points. 1% it has there reduced. It has come down to 3. So if you total all these things, so long-term repo operations, 1.8% of the GDP or 3.7 trillions of amount has been, they wanted to be released into the economy. That is what they are, what you call as estimating. So now again, the reverse repo rate, I told you reverse repo rate, thrice they have changed. So again, reverse repo rate, it was 4%, that is on March 27th, and again on April 17 to 20, what they did, again by 25 base points, it came down to 3.75. Again in May 22nd, they again reduced it to 3.25. Why is it that they have done so many times? The main reason here is that the commercial banks, according to one of the studies, are keeping, all these financial institutions are parking their money with the RBI. It has increased. And that is what is alarming. Instead of giving it in a form of a loan, they are parking it there. And that's the reason why they have taken up these steps thrice, going on reducing with the reverse repo rate. Have made around $3.1 billion just by parking funds with the RBI. They have made their money, interest, they have got that much. So that is the main reason why they are trying to reduce. And so then again, repo rate has been reduced to 4.4%. The 4.4, which was there in the during the first round, that is March 27, and now again it is reduced to what you call as 3.7, right? Again 25 base points. So repo rate 4%. So this, what does it indicate? They have been reducing these rates so that commercial banks and other financial institutions, basically it is commercial banks who have to maintain this repo rate, reverse repo rate, it is applicable to them. They have to lend more so that credit is available in hands of the people, because the problem is people do not have the liquidity now. Then whether to start a business, whether to spend, for that reason they have reduced all these things. So now that is how it is happening years. Reserve repo rate amount of 6.9 lakh crore is parked with the RBI. Understood? That is how it is happening. Now, what all other measures which they have taken, I'll just list out now. So now marginal standing facility to 3% of the statutory liquidity ratio. What is statutory liquidity ratio, SLR? SLR is basically every bank, that is by law, they have to keep either in the form of gold, securities, with whom? With the RBI. And earlier it used to be 26%, now they have brought it down to 18%. So that much has to be kept. So now out of that, 3% of it, you can use it as a marginal standing facility. You have that ready, you can make use of that. And then 3 months, as I said, postponement of your interest. Understood? Moratorium on loans, you can postpone. And now that has been increased up to August 31st. 3 more months have been extended. So on April 1st, the RBI created a facility to help with state governments' short-term liquidity needs and relaxed the export repatriation limits repayment. So that also has been increased. And then RBI regulatory measures to promote credit flows to retail sector. So retail sector, micro, small, medium enterprises, they are getting more credit. And then they get four-way thing on asset clarification of loans. So asset clarification of loans of this MSMEs and real estate developers have also been done now. And then these banks, the non-banking financial institutions, they have extended what your security sector classification, they have extended it and to up to 2021. So investment grade bonds, commercial papers, non-convertible debentures, so that has been again increased to what you call as 0.6% of our GDP, so that more funds are there with the non-banking financial institutions. So special refinance facilities are also provided up to 0.2% of GDP to rural banks, housing companies, small and medium-sized enterprises. And on April, any clarifications you can ask in between, or we can have the question and answer session later on. All the doubts can be clarified. Okay, so special refinance facilities of around 0.2 of GDP of rural housing companies and small and medium-sized enterprises that they have increased. On April 27, announced a special liquidity facility for mutual funds. Mutual funds also, that is called as Special Liquidity Facility, SLFMF, of rupees 500 billion and a fixed rate of 90-day repo operations for the banks, so that they are getting these funds, there's mutual funds also. And then on April 30th, the RBI extended the regulatory benefits under this scheme. Whether they avail funding from the RBI or deploy their own resources under this scheme, they can what you call as invest there. So that is the benefit they have given. So these are the various measures which have been taken place. On May 13th, the government announced measures targeting business. Collateral-free lending program with 100% guarantee. Second is subordinate debt for stressed. So more debt is given to the MSMEs. Then partial credit guarantee scheme for public sector banks on borrowing from if they are borrowing from non-banking financial institutions, they are getting what you call as partial credit guarantee. And even housing finance, microfinance, all these people have been benefited. A fund of funds for equity. See, these are the measures taken. Whether the commercial banks and other financial institutions are making use of that, only time can tell. Whatever we have got till now, that I'll be telling you what has happened. So RBI policy measures since February 8 represent liquidity injection of 4% of GDP. 4% they have injected into it. See, one more thing I want to share here is that you know that Nirmala Sitaram, that is fiscal policy, 20 what you call as lakh crores have been announced by her for various development programs. Out of that, it also includes 8% of the GDP. 8% of it is also for the for your commercial banks. It's part of it. It is not. This is not different. It is part of that the package which has been given by Nirmala Sitharaman. So ease policy extension of loan, as I told you, it has been extended to August, end of August. The increase in the large exposure limits from 25% to 30% of bank capital, relaxation of some of the norms for the state government financing, credit support to the exporters and importers, and an extension of tenure of small business refinancing facilities. So many 25 to 30% of the bank capital relaxation they have got. Now, refinance facilities for all India financial institutions. So, which are they? You would have heard in the TV that 50,000 crores has been released to NABARD, SIDBI, and the national housing banks. They have given to all of them. So, how it has been distributed? So, NABARD usually is taking care of others. So, here 25,000 crores to the NABARD, refinancing the regional rural banks. NABARD is basically looking into the agriculture part of it, agriculture and rural development. So basically they give it to the regional rural banks, it gives to the cooperative banks, and it gives to the what you call as microfinance institutions. One important thing about this microfinance, when I come to that, I'll let you know. MSME. You want me to explain it again? Which one you want? Okay, MSMEs you want. That is micro and small scale and micro and small scale industries. For that, the funds have been increased. Here, that is what it is saying. All these people are getting more. Microfinance is also there. So 15 crore to the SIDBI, and then housing. National Housing Bank for supporting housing finance companies. That has been, advances have been increased. They have given to what extent it reaches the ultimate, what you call as, whether it is a microfinance, micro industries, or it is what you call as rural banks, or it is cooperative banks, the money may go, but are the people taking it? That is what is important. Are these banks releasing it? That is what has to be looked into. So now, here, just I'll give you a glance of it, how has the situation been there in these 4 lockdowns. So if you see, saving deposits in the first lockdown period, it was okay. Second lockdown, it came down. And in third lockdown, it became minus. And again, fourth lockdown, it is slowly rising. If it is current deposit, if you see, in the first, people were having fear. All these businessmen, they have taken minus, it is taken away. And then lockdown period, it was, they have again put it, and then lockdown 3, again minus, and slowly again it is picking up. And then even the term deposits. What is term deposits? Term deposits are nothing but a fixed deposit and recurring deposits. And these are also what you call as being reduced, or people are what you call as disinvest, means they are taking away their deposits because people have to spend, they have required money. So whatever deposits are there, they are just liquidating it. So that's why it has come down. So total deposits, if you see, it has come down. Now, when it comes to advances, we know that commercial banks give advances. To what extent they have given in these 4 lockdown periods? So if you take cash reserves or if you take loan on the deposits, if you have already a deposit, you can raise a loan on your deposit, or it may be a overdraft facility. All this are in minus in all the 3 lockdown periods. And then in lockdown period 4, it is increasing. One thing we have to see, the operation of the commercial banks or banking system was itself little slow. So you cannot expect that they were giving any loans at that particular period. And slowly when they are opening up the economy, and that's how it is increasing this. And then term loans also. Now if you see lockdown 3, it has become minus, and lockdown 4, it is again picking up. So this is the situation about the credit which is there. So if you see the same, I have just briefed it in a nutshell here. So deposits, savings, current and term loans, it first increased. Second, it has declined by 25%. In the third lockdown, it is negative. And then the fourth lockdown, it is increasing. Okay. So then advances, when you talk about the advances are increasing, decreasing, decreasing and increasing. So this is the trend. So the middle lockdown period, first, it was not so severe. Second and third, being very severe, they have not given advances. But slowly in the fourth, it is improving. So now in lockdown 5, chances of savings to increase. There are chances that when people have resumed work, they are getting their salaries, people are bound to save. And not only that, even the credit will increase. The giving of the loans will also increase. Now, if you take the credit to deposit growth, how it year on year, it's basically from the month February, that is February 2019 to April 24, 2020. That is during this period, COVID period also. What we see is the deposits have been more or less stable. Of course, it has fallen during this COVID period and slowly it is picking up in the month of April. Whereas credit, even before COVID, it was falling, and now the fall is steeper. And it is now the credit provision is only what you call as deposit is 7.04% of the total reserves which they are giving. Now MSMEs, somebody was asking. So this is what is MSMEs, how much is being given, demand how much it is, supply how much it is. Because it's overall, I don't want to concentrate on only MSMEs, but just a glance of it, what is the situation. So if you take here, who are financing it? So this is the demand is more, but the supply from various banks and non-banking financial institutions and other banking government institutions, everything total supply is 10.9, but the demand is more, 36.7%. So there is a problem here that has to be financed. This is the situation. So, but this is that's the reason why more stress has been given to MSMEs, that they should get the credit. Now, how the banks have reacted to the situation after so many measures taken up by the government? What is the reaction by the banks? So, if you see, they have provided emergency loans. These are the various banks which you see on your screen. They are the various banks which have given the credit. So which are they? SBI has given, Bank of Baroda, then MSME banks, India MSME COVID loan has been, special loan has been given, and then salary loan has been given, Union Bank has given. So at what percentage it has been given? So the rate of interest has come down, 7.25, 8.5, each bank has its own. So usually, as the government has announced, the what you call as interest payments. Now, what is this EMI? EMI is nothing but equated, what you call as the money with interest, which you have to pay throughout the period. So that equated amount will be adjusted for the next, if you have taken a loan. So now you are not paying for 6 months. Now this 6 months will be adjusted from the August, that is from the September, whatever is your loan period, there they adjust, and no doubt you will be paying a higher EMI after that. So that is what is going to happen. This then Union Bank, all of them. Union Bank has given a moratorium of 12 months. There no need to pay up to 1 year your interest. You have to start paying only after that. Not that you are not paying. You have to pay that EMI, equated monthly interest. You have to pay it, but it will be at a later stage, and that will be adjusted to the period for which you have taken the loan. But of course, you will have a burden later on. So this is what we have to. So now today's situation is different. We are going for monetization of deficit of central banks. Okay. So if you take the situation of 1991, economic crisis was different in India. Then we had BOP problems, or is balance of payment problem, and we did not have sufficient forex reserves. So what we did then, we had to borrow from whom? From IMF. So what did IMF say? This is also a monetary policy which we did in. Why the situation is different from 1991? So at that time we approached IMF. IMF point blankly said that we are not going to give you any loans. Okay, they said we are not going to fund you unless and until you go for LPG. That is liberalization, privatization, and globalization. That is what the world wanted. We had to open up our economy. No doubt, it benefited us and it also benefited the world because of our opening up. And we got the loan at that time. But this present situation is totally different. What we are having, the problem is totally different. So we are bound to have deficit. Where are we going to get this money? We are going to borrow, or if you have reserves, we are going to use. So are we going to monetize? Monetize, always the monetization of the deficit is a big problem. Problem in the sense it is bound to create inflation. At present, no doubt, the inflation rate is low, 4%. But once money is there in the hands of the people, demand is bound to increase. But the goods and services, as I told you, will not be increasing in the same phase. At that time, we will be having various problems. So how to come out of this particular problem? That is the main risk. Inflation will be there. Again, contractionary monetary policy we may have to adopt at that particular time. So I have made around what you call as 3.1 billion, just as I told you that instead of giving loans, till now they have been parking the money with the RBI. So what is required now is liquidity to the market is being pushed. To what extent these banks are going to accept it and adopt to this is what has to be looked into. So now I think I'll open for the question answer session.
Good morning, ma'am. This is Siddharth Mohan, an ex-alumnus of MSRMI, batch 1113.
Okay.
Ma'am, this was a very wonderful session because it was a very technical topic which you made us understand in a very easy way.
Thank you.
So my question is, ma'am, it is good that the banking sector is open to give credit to all the sectors to revive the economy.
Yes.
But when it comes to the savings of a person, the banking sector is continuously reducing the base point, as a result of which FDs, basically fixed deposit, which the senior citizen sector of this company mostly rely upon. The percentage in the FD is reducing day by day. So don't you think it is something that is a point of concern for our country, because the senior citizen will be largely affected by it? And also, when you talk about mutual fund sector, as you can see,
You're not audible for me. Sorry.
Okay, ma'am. Am I audible now?
Yeah. You said about senior citizens. What is the problem with the senior citizens?
Yes, ma'am. When we talk about senior citizen, they heavily rely upon the fixed deposit scheme of the banking segment. Yeah. But the banking sector is continuously reducing the base point, because of which the percentage of interest that we get on FD is reducing.
Yeah, there are also benefits, as you must be knowing. There are extra benefits given to the senior citizen. 1% interest rate is always higher to the senior citizen.
It definitely is, but overall, due to the cut in the base point.
Actually speaking, we are in a better position compared to other countries. So if you are keeping your money in the banks, we have to pay the interest because you are safeguarding the money. That is the situation in other countries. Whereas in our country, at least we are getting some interest rates, which are not so bad. Okay. Anyway, that the RBI has to look into it and has to take care of the senior citizens.
And ma'am, even in mutual funds where like Franklin Templeton has freezed their debt fund account, and it is expected that more of such cases are going to happen in future. So is there anything that which can be done from the government point of view?
See how they are earning their interest. It depends upon the particular bank. As long as the benefits are given and these people are not able to get back their funds back and the NPAs are growing, the banks will always be under problem, isn't it? So somehow they see a bank, how do they function? There is liquidity, there is profitability. They have to balance between liquidity and profitability, and at the same time, solvency of the bank should not go. So it is in the hands of the where they are investing this mutual funds. Mutual funds is nothing but on your behalf, some agency is investing in different places. So how can you expect that the stock market is falling wherever they are investing? The situation is such that it is not rising, isn't it? How long? It all depends. Only once the economies recover, the situation may be better.
And ma'am, even before this COVID-19 issue, there was very big crisis in bank. If you take example of that bank in Maharashtra or even Yes Bank.
Yes,
so we were
correct. See here, what are these banks supposed to be done? It is in the interest of the general public. When they are misusing the funds, it should have been the responsibility of the central bank to have checks, proper checks. Somewhere it is a failure on the part of our central banks. They should have put a proper check on them and see to it that whatever money, and people also, whenever they are keeping their deposits with these cooperative banks and other banks, what is guaranteed? Only 1 lakh to 50,000. They cannot keep more than that. Even RBI doesn't guarantee it. Thinking that you are getting a higher interest rate, people have just blindly put their their savings there, and they are the losers, isn't it? Now, to what extent it can be covered, it is clear by the law that they can protect only up to 1 lakh, not more than that. 10 lakhs, 20 lakhs, crores of rupees, those who have invested, they are burning their hands now, isn't it? So, whenever such problems are there, it has to be auditing is there, direct control is there in the hands of the RBI. So, it has to be taken care of. So certain things we cannot just talk in the general in this platform.
Thank you so much.
Okay. Thank you very much. Was it interesting? Could you get answers for most of the questions?
Certainly.
How it works, I think that is what I wanted to tell you. Okay, thank you.
Thank you so much.
Yes, Gurupreet?
Yes, hi. Good afternoon, ma'am. This is Gurpreet, MS Ramaya ex-student, 1618 batch. Teacher, it was indeed a very interesting session. But I want to ask a question that how relevant is repo for bank rate setting?
Repo rate.
For bank rate setting.
Bank rate, as I told you, what is a bank rate? Bank rate is basically on rediscounting of your bills. The commercial bills, the government bills which are there, they are rediscounting those bills, correct? So that
absolutely
that particular rate they have not touched upon as on now, because
true
activity is not at all taking place now. They have touched upon the repo rate, they have touched upon the reverse repo rate, and then marginal facilities, giving credit, easy availability of the credit, and other things they have touched upon, not on this. Yeah.
So is it flexible for them to set the rate, or does it find some rigid conditions against it?
It is there because actually if they are that bond papers, non-banking financial institutions, they are doing that. They can do it, and so that it has become easier for them to do it now. That policy is also there. In my slide, you might have come across that. It has been there. They can easily get that. They can liquidate their bonds. So money is flowing in the hands of these banks. Yeah.
Good morning, ma'am.
Yeah.
Good morning, ma'am. This is Satyendra Singh Rathore from 2007-9 batch.
Okay. Hello. I think I have not.
Ma'am,
Yeah.
ma'am, this is Satyendra Singh Rathore.
Yeah. Got it. Go ahead.
From 2007-9 batch.
Okay.
My question is this: when you are describing about CRR, SLR, CRR, and repo rate, reverse repo rate, I just want to know to what extent we can reduce CRR. Can it be zero?
No, usually it can't be zero. If at all, if it is zero, then the liquidity problem will be there. Because if you keep your money and when you want your money back, bank should never say that we don't have money. The solvency problem arises. They cannot say that we can't give you your 1 lakh or 2 lakhs now. They can send you back. So they have to keep a reserve, which is a fall back. Understood? So there will be a rate. There has to be a rate. Up to 1%. They usually it doesn't. In our country, it used to be up to 10%. Only after banking reforms of 1991 new economic policy, we have reduced it to 4%, and it has 3% now because of the situation. 4 to 3. Yes. Thank you for the question.
Thank you, ma'am.
How do you feel it? Any other clarification you want?
Hello, ma'am.
Hello.
Ma'am, this is Tejashwini from 1820 batch.
Tell me, Tejashwini.
Ma'am, if you continuously decrease the rates like repo rate or reverse repo rate or CRR, then won't the rupee value will decrease?
No, rupee value directly does not decrease. It doesn't have that an impact. Only money supply will no doubt will increase. And that's what I'm telling you. Money supply is increasing, demand will increase. With the increase in the demand, there has to be supply. Production has to take place. So first stage is that they are improving. And that's the reason simultaneously we are also having a fiscal policy so that it has to substantiate. The growth has to take place. Otherwise, it will lead to inflation. When it leads to inflation, automatically the value of money is going to fall. It's related like that. Okay?
Thank you, ma'am.
Ma'am, this is Avinash here.
Yes, sir.
Thanks for the wonderful presentation. It was very informative.
Thank you.
I have a question which probably I'll take around 30 seconds to 1 minute to explain. This was related to collateral-free loan scheme which has been announced. The first thing is government is betting on already a risky segment because we see that according to RBI data, banks already have a total outstanding loan of almost 29 lakh crores to MSMEs. So first thing is they are already betting on the risky segment.
Not audible. Getting clear. There is echoing.
Yeah, can you hear me, ma'am?
Huh?
Can you hear me?
I can hear you, but clarity is not there.
Okay. The first thing is this is related to collateral-free loan scheme.
Yeah.
Government is betting on already a risky segment, which is MSME. Almost 29 lakh crores are due already. That is on one side.
So NPL is going to increase. There is no doubt about it. Because of this, non-performing banks are bound to increase. How will they have going to cope up is the headache for every bank.
Yeah, and most importantly, ma'am, a few of the other important questions. What we observe is fundamentally there is a demand problem also. More than pumping the money, the demand creation is important.
Yes.
And informal credit guarantee is also going to be one more challenge. And there is a high probability of misuse. And there is no solution for immediate cash use also.
Correct, that very rightly said. That's true. Demand will increase, but what type of demand will increase? What type of goods will be produced? As it is in our country, we are not going in a right direction, isn't it? But one good thing what we have understood with the COVID is that people are not spending on luxurious items. What is required for a country like India is we require most. See, even now, finally, who are under problem? It's not the middle class. It is basically the lowest class which is suffering today.
Yeah.
It's not the middle class, it's not the rich class. They do not have employment. They are now, if you say the workers, they earn if you say construction workers and this, whatever they are going from one place to another, they are not beggars. Our governments are treating as if they are beggars. It's not right from our part, isn't it? They are ready to work. You have to give them the work, and then only the demand will increase.
Yeah.
That situation is there. The way they have been treated is not right. That's
Yeah.
what
Yeah.
demand. That's what, in the right direction, the investment should happen. Luckily,
Okay.
agriculture is there. Our service sector is improving. But what is required is manufacturing, employment, and we are depending upon China. Most of the components have to come from China, and that
Yeah.
we cannot ignore. We have to depend somewhere or the other for the industries to manufacturing to start. The components are from there.
Yeah.
It's a
Yeah. Well, light on the immediate cash use what MSMEs require, ma'am.
hello, sir.
Yeah, immediate cash requirements of MSMEs, how it could be handled.
So audio problem is there. I'm not able to catch the question. Thank you. You can post it later. How long should we wait for the recovery? Time alone can say that. Hoping that by next what you call as financial year, our situation may improve. May not be the growth rate of 5%, 6%. At least 3 to 4% growth rate can be expected. And employment also. The complete situations are changing. How much investments are coming to our country? Now, because China people are hesitating, there are chances that we can take advantage of that situation and investments can take place in India. Investments can happen in India. And that's the reason why labor laws and other ease of doing business, this has to be created in our country if we have to recover faster. Any more questions? Anything else? Any more questions, students or participants? Yes, some question. Yes, Adil, what is the difference between money supply and liquidity crunch? Okay, money supply is the amount of money in the circulation. Whatever it will be from in the hands of the people. It is in the banks, commercial banks. It is whatever the liquidity is available. And liquidity crunch means there is shortage of these funds. Money supply is less. Liquidity is nothing but money supply. Money supply is what is available in the economy. The liquidity which is available. Crunch means shortage is there. Is it clear? Any more, little more explanation required? Information and repo rate. So, repo rate is the rate at which the commercial banks can raise funds from the RBI. They are getting funds from the RBI. So, if they are able to get at a lower rate, now it has been reduced. So then for them, taking the credit from there and passing on to the general public will become cheaper, easier. Any more? Yes. Any doubt? How much money the RBI can print will depend upon the situation. That is what is called as monetization. If at all if there is deficit, if they are not able to get it from their reserves, they are not able to get it from the borrowings, then the last resort is always this minting. And that minting, there is some 115 crores worth of securities, gold has to be kept, and depending upon the situation, they can print the currency. And usually that is never disclosed, but they can do it. But in our country, we are not in such a situation that we have to go to that extent. Already there is liquidity available, only that channelization is required. Okay, friends, thank you very much. It was a good interaction session also for me. Thank you.